To explain leverage to you, let me tell you a little story. You wish to purchase a house. You have $20,000 and you see an opportunity to purchase a house valued at $100,000. So the purchase is $100,000 because you've only got $20,000. You go to a bank and you borrow $80,000. $80,000 combined with your $20,000 means you now own a property worth $100,000. So that $20,000 has given you control of a property worth $100,000, which is 5-to-1 leverage. Because basically $20,000 goes into $100,000 5 times. Carrying on the story. After 1 year, the property prices have risen by 50%. The property is now worth $150,000. You sell the property, giving back the $80,000 to the bank, taking back your $20,000 deposit, but this time you've taken along with you a $50,000 profit. You see, that 1-to-5 leverage has meant your $20,000 has given you the opportunity to make $50,000 profit. Let's say it's another side of the story. Say, for example, instead of getting a mortgage and buying something for $100,000, you use your $20,000 instead to purchase a studio apartment for $20,000, which is 1-to-1 leverage because $20,000 goes into $20,000 1-to-1. Same thing has happened. Property prices have gone up 50%, and now that studio apartment is now worth $30,000. You sell the property, taking back your $20,000 along with your $10,000 profit, because by using that 1-to-1 leverage, you've made a smaller profit of $10,000 as opposed to using a leverage of 5-to-1, where you made $50,000 profit. But let's bring this into contents with Forex. And here's an example. You invest $1,000 into the market. You're trading the euro dollar. You're selling it at the sell rate of 1.1688. You're trading a lot size, a standard lot size of 1 lot, which is 100,000. 1,000 into 100,000 goes 100 times. So the leverage you're using is 1-to-100. Same calculation applies. 0.000855578 times a lot size. Using 1-to-100 leverage means that pip value is now is actually worth €8.56, which is basically $10 per pip. 10 pips moves in your favor means that you're actually in $100 profit. Let's do another example. This time you invest $2,000 into the market, trading the euro dollar, 1.1688. Lot size still 100,000. But 2,000 into 100,000 goes 50 times. The leverage you're using this time is 1-to-50. Same calculation applies. €8.56. However, because you're only using 1-to-50 leverage, you halve that. So in fact, your pip value is actually €4.27, which is $5 a pip, which means $10 pip movement would have been potentially a $50 profit. So here's the argument. And a lot of people ask me, Alexander, they say, look, obviously if I used 1-to-100 leverage, I'd only have to invest 1,000, and potentially I have earned a lot more. Because you're right, if you go in your direction, you would. However, here's the flip side of the coin. Had it gone against you 10 pips, you would be minus $100. Opposed to using leverage of 1-to-50, had it gone against you, you'd only be minus $50. So this is why I stress that you must understand leverage. And it really does depend, A, on your attitude to risk, your risk management program, and also your account balance. Now, as I said earlier on, the Forex market is 24 hours a day, Monday to Friday. And because obviously we're not awake 24 hours a day, it's actually split into sessions. Now, the Forex market technically opens around about 6 a.m. Sydney time on a Monday morning. and closes at 5 p.m. New York time on a Friday. So 24 hours, Monday to Friday. And because, like I say, we're not awake 24 hours, it's actually split into 3 main trading sessions. The first session is the Asian session, which really involves Sydney and Tokyo. This opens at 6 a.m. Sydney time. It closes at 5 p.m. Sydney time. So basically 11 p.m. Sunday night GMT to 8 a.m. GMT on the Monday morning. It's a smaller session in terms of trading volumes, and it really involves cities like Sydney, Tokyo, and Singapore because, of course, they're wide awake. The currencies were most liquid during this session, even though, like I say, the euro, the pound, other currency pairs are still traded because they're available. But the ones that tend to be most liquid tends to be obviously the countries which are awake. So the Aussie dollar, New Zealand dollar, Japanese yen, because Australia, New Zealand, Japan are all trading. After that, we then have the European session, which is basically, for the time being, depending on what unfolds, the Brexit or the Brexit, whatever you call it. I call it a nightmare and total mess. But yes, mainly it's London. London opens at 8 a.m. GMT and closes at 4 p.m. GMT. This is the biggest trading session, and it makes up nearly 50% of the total trading volumes and is extremely, extremely liquid. Cities which are trading at this time, of course, includes the likes of London, Paris, Frankfurt, and Zurich, because they're awake. And the most liquid pairs during this time includes the likes of the euro, the British pound, and the Swiss franc, for obvious reasons, because both Europe, the United Kingdom, and Switzerland are awake and trading. Then we have the North American session, which is New York. This opens at 8 a.m. and closes at 5 p.m. So basically 1 p.m. GMT to about 10 p.m. GMT, depending on summer or winter time. It's the second biggest trading session in volume, so it is indeed highly liquid, but not quite as liquid as the European session. New York, Chicago, and Toronto are the main cities at play here. And the currencies to watch, of course, is all the currencies trading against the US dollar and obviously the Canadian dollar. Now, here's the thing about this session. This session crosses over with the European session, which means it has the potential to be extremely volatile because at the same time, you have 2 of the biggest sessions all awake and all trading. So again, depending on your attitude to risk, you may be wary of when the crossover happens. However, once Europe closes and the tail end of the New York session is coming to an end, last couple of hours, liquidity slows down before it then switches back on to the Asian session to take over. Now, another thing I like to cover in this sort of session is discuss a little bit about market jargon, because, you know, like every industry, every profession, there's all these different words people like to use. They don't like to use simple English because, well, you know, it's far too easy to do that. So here's some jargon on what it actually means. Go short or shorting. This basically means to sell or I'm selling. So if I go short or I'm shorting something, I believe something is going down in value. If I go long or I'm long, means I'm going to buy an asset because I believe it's going to go up in a value, or I'm buying an asset because I believe it's going up in value. Squaring up basically means I'm closing my positions. The market is crashing basically means the market is selling. So the market is actually more fearful, so things are dropping. The market is rallying, means there's optimism, so the market is buying. Opening bell basically means the market is open or opening. Closing bell, well, I guess you can guess what that means. It means the market is closing. Other jargon, we have a fat finger. This basically means sudden market activity caused by a mistake made by a single trader or group of traders. A flash crash. This is a crash in prices caused by a computerized system error. Limit order. This is an order to buy an asset or sell an asset at a fixed price. As well as that, we then have things like different nicknames for currency pairs. We have the cable, which is the British pound, US dollar. The loonie, which is USD, US dollar, Canadian dollar. Greenback, which is, or the buck, nickname for the US dollar. Kiwi, surprisingly named for the New Zealand dollar. Aussie, go and have a guess. You've got it, Australian dollar. yellow metal, which is gold, and the Swissy, which you've guessed it, is the Swiss franc. There's also lots of different animal kingdom, different jargon related to animals. Okay, we also have the likes of hawkish. Now, hawkish means this is a statement made by a member of a central bank which is aggressive and hints at possible rate hikes or monetary policy, so aggressive, optimistic tone. They're described as being hawkish. Then you have dovish. This is a statement made by somebody of the central bank which maybe drop hints of maybe rate decreases or maybe a little bit more nervous in their comments. So they're dovish when they're like this. A dead cat bounce. This is when an asset's been falling and suddenly jumps up before continuing to fall again. Then you have bulls and bullish. These are individuals who believe an asset will rise in value. So if I say I'm bullish about gold, not saying that I am, but say if I was bullish about gold, I would be sort of, believing the gold would go up. So bulls are optimistic, believe something's going to go up in value. Bullish is an optimistic belief. Bears or bearish is the opposite. These are individuals who believe an asset will fall in value. A bull market, this is when a market is rising because there's a great number of bulls involved, buying, so the market is rallying. And then you have a bearish market, which is the opposite, which means the market is falling because the bears are taking over the market. They're more nervous and they're selling the assets off. Like I say, up and coming event. Next one is 27th of February, which is Exploring the Markets, episode 3, which should be my introduction to technical analysis. If you wish to ask me questions or contact me, please feel free to email me at alexander@olympusmarkets.com. I'll be more than happy to answer your questions, or if indeed you wish to hand feedback on this episode, or what I like to say, any suggestions of future episodes or content in future episodes you might want me to do. On that note, can I wish every single one of you a massive thank you for joining me tonight. I hope you found this episode enlightening and interesting, and I wasn't too boring for you. Till next week, have a fantastic evening, fantastic afternoon, or fantastic morning, really, depending where you are around the world. Till then, every single one of you, trade safe.